In this video, traders going to address the question, if there's not enough swing trading setups, what do I do? Stay tuned. Hey guys, a very warm welcome to you. All right, so Mr. W asked a question, put a comment, and very much appreciated from you, Mr. W. And it was along the lines of this. I'm paraphrasing slightly, but it was along the lines of, I'm trading the indices on a swing trading basis. I'm using a 1 hour and four hour chart to execute. That's my strategy. That's what I want to do. So that's a real good thumbs up there, because he's got his nailed down his markets. He's nailed down his strategy. And he's nailed down his time frame, all good stuff. The problem is that there aren't enough setups occurring in the indices. And one of the things that he mentioned, quite rightly again, is that a lot of the indices are all correlated. So DAX is going to move in sync with FTSE, and often Europe moves in sync with Asia, moves in sync with the US. They're all relatively similar. Yes, there's some differences between the two, and yes, we might say that sometimes one market stagnates and the other drives up, and one maybe tech goes in the others. But generally speaking, on a broad spectrum, if they're active, they're all active. If they're quiet, they're all quiet. So his observation is, I'm trading indices, I'm maybe trading once a month. How can I increase the learning curve, which is something I talked about in another video, which is probably uploaded now for another question, and B, kind of reading between the lines of the question there is, how can I kind of increase the volume of my setups? Because if you want to make more money, the kind of dilemma that Mr. W is in there is, do I kind of size up on those once a month setups? But then of course, if I have a little bit of a bad run and let's say 4 or 5 of them don't work in a row, that might be quite devastating, and having to ride that out because you're having 4 months of kind of drawdown, 4 bad trades over 12 isn't the end of the world if those others are decent. But perhaps that doesn't really work because you're gonna have a big drawdown on your account. So the other thing to do is to increase the volume of setups. But of course, if a lot of the things you're watching are correlated, you can't do that. So a couple of ideas here that maybe you can use to go in. The obvious one, and there might be a reason why you don't want to do this, but the obvious one is to go and look at other markets. Now, I don't want to be too broad with that and say we're just going to look at any other market, because you want to look at markets that have a similar kind of movement to the indices. So it's not going to be small cap biotechs, for example, and it's probably not going to be some of the thinner commodities. Now, you don't say specifically what indices you're trading. To me, there's a little bit of difference between the S&P 500 and the DAX, but on a swing trading basis, perhaps not so much. So you want to find stuff that's moving like that. And for me, the really large cap shares behave a lot like the indices. So you can look at stuff like Apple, you can look at stuff like IBM, you can look at stuff that's a slow burner, but perhaps is out of sync with the index at the time, because obviously the main kind of response to that is, well, if they're big players, they're going to be moving in sync with the index, especially someone like IBM, McDonald's. And yes, very true. But if you pick a bigger stock or a higher market cap stock / shared, whichever kind of exchange you're looking at, and it is out of sync with the current market conditions, perhaps there's been earnings or something on it, it's smoothed out a little bit, so it's still behaving like an index, but perhaps it's a little bit weaker, then you can trade those. And there's actually, there's probably a few hundred bigger, larger cap stocks that are trading in a completely different manner to the indices, but you can still treat them like an index because their behavior is a little bit more like it. Generally speaking, this is my rule of thumb, guys, is that the bigger the volume and the larger the market cap and the more trades per day, the more like an index it is, because you've got two-way flow. When it goes to the other end of the scale and the volume's down, the trades per day is down, the number of transactions is down, then it tends to be more jerky and more of a completely different way of trading. And what you don't want to do is kind of look at other stocks that can trade completely differently, because number one, the strategy might not be effective in those kind of stocks, and number two, you're kind of diluting your focus. So pick a few larger stocks that act a little bit more like an index, aren't specifically correlated, so that you're not getting the correlation issue that you mentioned earlier, and look at those and try and find stocks that are perhaps in a steady downtrend, but very, very index like, maybe stocks that are range bound or whatever conditions you're looking for, and trade those like an index. And yes, there's some issues in terms of, which shouldn't affect you too much in terms of swing trading, but there's some issues in terms of cost to trade, margin requirement, etc. But if you're, I'm not sure if you're CFD trading or spread betting, costs are, yes, a little bit more, but we're not talking a huge amount, and you can still trade them a relatively small amount as well if you want to kind of get used to it. So that's one way of doing stuff. Another is to add things in that are a little bit more index like the bigger commodities. At the moment, at the time of filming this, gold is a little bit slow, it's chuggy, it's not got that massive volatility, it's a little bit more index like. The forex pairs at the moment are very, very dull, so you might not want to go there. That may change by the time you watch this, and if you're watching this and it's related to what you're thinking about, then it might be different kind of scenarios and market conditions out there. But I guess the summary of the video is to say, okay, if you've got this conundrum, right? And I've been here myself with trading from a day trading perspective. You're trading one thing, and perhaps the opportunities aren't there. It's not as volatile as you'd like. So you've got two choices. Do you add more setups to the strategy, which potentially would work, but then you've got to learn something new and try and get something that's effective? Or do you widen the net in where you're fishing? So if you've got one setup and one strategy, and let's say you're getting a 1 month, one trade a month hit, do you then add more setups and strategies to get 3 or 4 a month? Or do you widen the net out of the index range into a wider sea, if you like, and start picking up those higher cap stocks, start picking up those smoother commodities, and using that setup that worked in the indices across those? So really you've got two choices. Add more setups or widen the net. I tend generally, if that setup's working great and it's working well for you, excuse me, in terms of risk reward, all that kind of stuff, I would stick with that, but I would widen the net and test that out. Obviously test it out small and see how you get on, and see if you can find stuff that trades and is conducive to the setup that you're using. But that would be my first port of call. Anyway, appreciate the question, as I do all your questions, guys. Comments, support, likes, shares, etc. And I'll see you in the next video. Take care. Bye bye.